I'm an investor that's accumulated enough retirement where if I can get a 4% dividend yield on my portfolio, I could live off of that. But I really like Amgen stock, but it only yields 3.15%, which is below my 4% need. However, the dividend has grown every year, as you can see, since they started paying one back in 2011. So what should I do? Can I own Amgen, even though it's reasonably valued? Or how do I make sure that I can have a portfolio that yields me 4% and accomplishes my goals? Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. And as promised, I'm going to do a video today talking about portfolio strategies. Okay, I want to be real clear before I go any further. I'm not suggesting that the strategy I'm going to show you right now is one that you should do. I'm simply going to point out that it's a type of strategy that you could apply or utilize in your own personal investing strategies if it met your goals and objectives. Because here's the thing. I often say it's a market of stocks, not a stock market. Well, I'd also like to add it's a market of investors, not an investor's market. In other words, every investor is literally unique. We have our own goals, objectives, risk tolerances, needs, financial needs, income needs, etc. So what I'm talking about here in this video is really how to be creative with your investing strategies so that you can construct a portfolio that you can live with. In other words, that meets your risk tolerance, a portfolio that meets the objectives you're looking for. And our focus on this video is going to be about generating at least a 4% dividend income, because I'm going to assume that as the retired investor, that's how much yield you need in your portfolio. Now, just a quick word on how to determine that. You want to determine that. Let's say you have $1 million, that you've accumulated for retirement over your life, and you need $40,000 a year. Well, that would be a 4% dividend yield. However, if you needed $80,000 and only had $1 million, you would need an 8% dividend yield. Now, an 8% dividend yield is probably unrealistic. A 4%, however, can be accomplished, but it doesn't necessarily mean that every stock you buy has to have a 4% yield. So what I'm saying is, depending on how much money you have, what your needs are, what your income needs are, is going to determine, what type of portfolio strategy you can build. So I'm going to assume here an investor has enough money that they only need 4% off of their portfolio to live on. But now, having said that, there's other considerations as well, because we know we live in an inflationary environment, so that 4% yield also has to keep up with inflation. And frankly, as an investor, we'd like to make a little money along the way as well. Now, the only way that we're interested in quote unquote beating the market with this kind of strategy that I'm talking about would be, are we getting more income than the market itself would be able to generate for us? So what I've done is I've done a very hypothetical exercise here. I've created two portfolios, really, which is meant to be built as one, where I'm only going to include 20 stocks. Now, most investors might need 30 or 40 stocks. Some investors might need 50. Some of you might be satisfied with 20. So it's not how many stocks I'm using or, et cetera. I'm just trying to give you the idea of how you can implement a strategy that could work. So our goal here is, I want to summarize and repeat. Our goal here is to build a high quality dividend income portfolio with reasonably safe companies where I can have, a sleep well at night type of portfolio. I want to get enough diversification to protect myself, but I don't want to over diversify my portfolio. And I need a 4% yield. And I also want the portfolio to be able to fight inflation over time. So what can I do? So I'm going to be playing with some strategies here. I put together a simple strategy using only 20 stocks. But the key point is it's use your imagination and your creativity to construct that portfolio. This portfolio may not work for everybody. Some of you simply could not handle maybe the risks that would be associated with this. Others would be very, content for a portfolio like this. Some of you might need twice as many stocks. Again, some of you might be happy with half as many stocks. That's for you to decide, but I want to go through strategies you can utilize. So let's go look at FastGraphs here, and let's look at the portfolio. The first one I'm going to have, I call max income, okay, maximum income. And this is what my strategy is. I'm looking to get a yield that the market itself is capable of generating me. Now, the market's yielding somewhere around 2%, 1.9, I think it is. The point is, I want to get a higher than market yield. So I'm looking at stocks here on this group of 15 stocks that have a minimum of a 3% yield and goes all the way up to 6.3 in the case of Verizon. So here I would put a third of my money. I would put, if I had $1 million portfolio, I'd be putting $33,333 basically in each of these 15 stocks. Okay. And what that means is I would put half my money in these 15 stocks, and I'd be averaging, something close to about a 3.5% or better yield. You'd have to add all these up and divide, which I'm not going to do here. Now, the other half of the portfolio, I want to be very aggressive, and I'm going to invest 50% of the money in 5 stocks, or putting 10% of my money in each of these 5 stocks that have these higher yields. Now, some of these stocks are riskier stocks, some of them are not. But generally speaking, 3 of them are below investment grade, or at least don't even have a credit rating as far as credit ratings go. They have all very high yields. I got 5% on international paper, which is investment grade. I've got 4.7% on 3M. This is when I, constructed these. I've got Altria at 8.1%. I've got Medical Properties Trust, which is a REIT, which is kind of an aggressive stock, but it's got a 9% yield, and then NSA at 6%. So I'm really heavily weighting my portfolio in these riskier stocks. And then what I'm doing is I'm using this other portfolio comprised of all investment grade stocks, where I put the other half of my money that also have very attractive yields that I can utilize so that I can put together this portfolio and average over 4%. But in addition to averaging over 4%, I also want to make sure that I've got some growth in the portfolio. So let's start by looking at these stocks on this first list. Now, I'm going to do them in alphabetical order because that's the way FastGraph works best. So I'm going to start out by looking at Amgen here. Okay, now I put this portfolio together, just so we know, on the 5th of January, because I wanted to do it at the first of the year. So as time goes on, in a year and maybe 2 years or maybe 3 years, we can measure how this portfolio worked out. And I'm using free cash flow here because this is a dividend portfolio. And my key here is I want to make sure that I've got enough cash flow, free cash flow, to cover the dividend. But I also want to see dividend growth. Now, Amgen, being in alphabetical order, has a really good track record of dividend growth. Since they started paying a dividend in 2011, they've grown that dividend by over 30% a year. But that's because they had a really high growth in 2012. If I look at it more detailed, you can see that it's starting to average about 9 or 10% growth over the last 3 or 4 years. And that's what I would want to expect from the company. Now, this particular company has outperformed the S&P on capital appreciation over the long-term time frame here. It's outperformed it, interestingly, on dividend income also, but again, it's only paid dividends since 2011. So we're going to buy it here when it's, I'm going to assume that it was purchased at an attractive valuation. And I just want you to get, thinking about how these works. Now, I'm going to use free cash flow for most of these stocks. Some of the financials I won't be able to, but I'm going to use free cash flow because what I want to see is this orange line, the free cash flow on the graph, is higher than the white line, which is the dividend. That means I've got more free cash flow than I have dividend income. So that gives me a safety factor. I've got a BBB plus company here, and I've got, a major biotechnology company here that's been, really a growth juggernaut, as you can see, over all this time. But so I'm looking for a current yield of 3.15% in Amgen. Now, AVGO, when I look at Broadcom, I always call it AVGO because that's the symbol. When I look at Broadcom, I've got a company that tends to trade at around 18 times cash flow. Here we're using free cash flow. Once again, my free cash flow is well covering my dividend, so I feel very confident about that. I've got a 3.19% dividend yield. Now, I'm below my 4% threshold. The next stock I'm going to look at is Conagra. Now, Conagra is a little more iffy, but it is a triple B minus rated company with only 44% debt. I'm not using free cash flow as a valuation metric. I'm using operating earnings as my metric. This is not a fast growing company, but it does offer a 3.25% yield and does give me a triple B rating. I've got some comfort in Conagra, which is basically packaged foods and meats, that, this is a good quality company. Now, I'd like to have bought it cheaper, but for sake of this video, I'm just showing you the type of companies. Now, Edison International is a utility, electric utility stock. Again, not a high grower, but it does yield now 4.35%. So this one gives me over my 4% yield. And if I look at the historical growth of the dividend's grown by, on average, about 5.8%, compounded growth of about 7%. But again, I want you to focus on the details. They did cut their dividend slightly in 2005, and that would be something I would consider as I'm looking at the stock. But it's a good utility. It's got a good dividend record, and I can get a 4% yield. I'm taking what the market's giving me. I'm looking at Eastman Chemical here, another one that has a really good dividend record, yielding about 3.57%. I'm buying this one, I feel like, in a very attractive valuation, where I've got some real nice upside built in here, even though this is a semi-cyclical stock. As I was doing this, by the way, I would always check the analyst scorecard on each of these companies to see how much confidence I would have. And I do want to make another point. I'm doing a high-level presentation here. I would go and spend a lot of time analyzing each of these companies before I invested in them. And I've done that, and I feel pretty confident about all these. Corning is another one. I'd like to have bought this one a little cheaper, but it does offer a 3% dividend yield. It's got a very good dividend growth record. And, future growth is expected to be pretty nice. So I'm looking at a decent rate of return going forward on this stock. I can go into my forecasting calculators, and, the analysts are looking for double-digit growth, which would give me some capital appreciation mixed in with my utility stock that I'm not expecting to get great capital appreciation from, or lower growth. So again, I'm blending these kind of companies together. HP Inc. is very attractively priced, in my opinion. Using a shorter time frame here to give you more insight, you can see the stock is traded at about a 12 PE. It's below that now, trading at a blended PE of 7.27. So I feel like I've got a 3.67% dividend yield. I've got very good valuation. I got very good upside. I'm using this as part of the portfolio. IBM has been going through transition from mainframes to the cloud. They're starting to, get some good earnings growth strung together here. Forecasts look for, 8% growth going forward for the next couple of years. The analyst scorecard on IBM is a little suspect, because the company had missed estimates all these years when it was going through transition. But in the old days, IBM used to have a pretty good scorecard. So I'm thinking my way through this process. But I like IBM because it's one that offers me more than a 4% dividend yield currently, which meets my criteria. I'm looking at Medtronic. This is a company that typically sells at a premium valuation. I often use this in showing how important valuation is, because the market put a very premium valuation on this stock for years before the recession of 2008 and 9. And then it got very inexpensive during that period of time, which had been a great time to buy it. It's now come into decent value again, and it has a 3.5% dividend yield. And it's got a really excellent dividend growth record. It's actually, increased its dividend every year. And it's A-rated with only 26% debt. So I really like this from a safety point of view. Network Appliance is relatively new to the dividend scene, but they have a good record of raising their dividend. They give me a 3% yield. They're trading at an extremely low valuation, in my opinion, which gives me a lot of upside potential in addition to the dividend yield. Northern Trust, an asset management and custody banker, is staying at a very low valuation. It's got, good growth potential. And because it is a financial, this is one that I would not be looking at operating cash flow with, because, their cash flows, the way they report cash flows is different than, traditional companies. But I like this company. I like the valuation. It only has a 3% dividend yield. It doesn't meet my 4% criteria. I like Omnicom, very inexpensive, a good record of increasing the dividend. It's triple B plus rated, just short of an A rating, which I really like. So that's Omnicom. I'm going to look at AT&T, which recently had a spin-off. It's more than a cut of a dividend. They actually spun off the Warner. As everybody knows, the company is beginning to grow again. I think it's offering a 5.8% dividend yield. I think it's very inexpensive today. I like AT&T. I would add this now. I think it's a good time to be investing in it. Truist Financial is a major bank, A-rated. It's got good growth. It's trading at a very low valuation. There's talk in the Wall Street Journal today about banks having some weak numbers. That's already reflected in the fast graph that this year is expected to be weak with almost no growth. It might be worse, might be slightly better. But then in the future, Truist looks like it's got upside opportunity. I've got Verizon here, which I consider to be extremely cheap, not growing very fast. If I really shorten this time frame, we've had almost no growth. It's the valuation here that attracts me. The stock is so inexpensive with a 6% dividend yield, and its dividend record of growing the dividend is relatively meager, only 2 or 3% a year. But I'm making up for that by having the high current yield. Okay, so I'm not going to get a lot of growth yield out of this, but I can use this to average in to my 3%ers to get me up to that 4% yield. There's Verizon in the group. Now, this group here is going to give me a pretty decent yield. As you can see, I'm going to have something, I've got 5 of these stocks, I guess, 1, 2, 3, 4, 5 of these stocks that are meeting my 4% need that I'm talking about, and the rest of them here. So I'm pretty close to hitting my 4% goal just by having half of my money in these stocks. So I'm hitting it with half of my money. Now, the other half of the money, I'm going to be a little more aggressive, and I'm going to invest in these more aggressive companies with higher yields, like International Paper, which is a little spotty on cash flows, but it's yielding 5% right now. The stock is inexpensive, and from an operating earnings point of view, it looks a little better than I like it from the cash flow. But I've got my 5% yield, and they've raised their dividend pretty well for the last 4 or 5 years. So I like International Paper. I've got 3M. I think it's extremely inexpensive. The company does have some problems, but it's yielding 4.7%, so it's going to help raise my average. And the dividend so far has remained intact, and they've continued to grow it, and they're expected to continue to grow it going forward. Altria, the old Philip Morris, I can get an 8% yield, and that really increases my dividend yield. And I'm buying it, I think, at an extremely low valuation. And this company's gone through all kinds of, issues from the standpoint of operating cash flow. This company's operating cash flow has been a little suspect in recent years, but currently their operating cash flow is covering the dividend. I like Altria very much. Now, Medical Properties Trust is a REIT. It's a healthcare REIT. It's extremely inexpensive. It's not expected to grow very much. The real allure here is a 9.37% dividend yield that seems to be well covered by funds from operations because this is a REIT. And so I like this company for the 9.37% dividend yield to give me a kicker. I believe the risk is already, built into the price of the stock. So I feel very good about holding this for the long term with a very, very attractive dividend yield. And then National Storage, which is a specialized REIT in storage units, is also very inexpensive with a 6% dividend yield. And I like it for its valuation. You can see the market has historically traded at a premium valuation to its funds from operations. And you can buy it now not only below its normal price to FFO, but you can buy it below its actual theoretical FFO justified valuation. And it does offer a 6% yield. So what I've done here is I've put together a portfolio where I'm averaging well over 4%. And, I've done it by overweighting some of the stocks and then equal weighting the others. I could have also equal weighted this whole portfolio. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Hope you enjoyed this video. The idea here was to be creative in your strategies, to make sure you're investing for your needs and your goals and your objectives and your risk tolerances. Every investor is not the same. So if you really needed a lot of income, now I'm going to do another video next week where I'm going to focus more on total return, where for the investor that's maybe still has 10, 15, 20 years or more before retirement. And I'm going to talk about how you would put together a portfolio there that had more growth potential. This portfolio should generate capital appreciation over time, more from some companies, less from others. but it should also grow the dividend over time, and it should also meet the 4% minimum yield that this particular theoretical or hypothetical investor needed. So you want to build a portfolio according to your needs and investment objectives. One size does not fit all. Next week, I'm going to talk about putting together a portfolio that is focused more on capital appreciation with a dividend kicker. So I'll be willing to look at stocks that might have a 2% dividend yield, but that are growing that dividend very fast. So tune into that. If you like this video, give me a like, ring the bell, subscribe to my channel, of course. And also you might want to take a look at Fast Graphs. You can see how versatile and how powerful it is in helping you evaluate all the others, all different kind of stocks. I do want to make one last point here. I'm going to go into the portfolio section of Fast Graphs, and I want to show you all something. So let's go back to Fast Graphs for a moment, and I'm going to go into the preset portfolios. Where I found most of these companies, I went places like the S&P 500, okay? And then I created a value portfolio for them. And then I went into the PE section, and I listed them by lowest to highest PE ratios. And I also used earnings yield. I'm looking for the highest to lowest earnings yield. So I'm looking for stocks that had good valuation, good credit ratings. And I started out by looking at stocks with good dividend records, ones that had good dividend yields. I didn't chase the massive yields. I tried to stay with companies that had reasonable yields and good quality ratings. But I could also go into the other set that I like to use frequently is the S&P Dividend Aristocrats, because these are the companies that have raised their dividend for 25 years or more. And I do the same thing here. I go looking at earnings yield. I'm looking for over 6% earnings yield. And so, when I get over 6%, that means these companies are, reasonably valued. But then, of course, I would then have to look at dividend yield. And I could sort these by dividend yield as well. And by going through this process is where I was able to identify the companies that I found that I put in these portfolios that were attractively valued, decent quality, good dividend records, and of course finally had the yield characteristics. Anyway, thanks for watching. Talk to you again real soon.